Hello, everyone. Thanks for making it here. And it's always interesting when I'm asked to do a presentation because you have to find things that are kind of appeal to a large group of people. And I can't really think of a better topic than the decision of using a debit or credit spread. It is probably one of the most confusing of all topics. I've seen people say, oh, I trade nothing but debit spreads. I've seen credit spreads. I've seen entire books written on just credit spreads. And it's really a mistake. So I thought it'd be a great topic. Let's take a look at why it doesn't really matter if you're using a debit or a credit, and what criteria should you be using to make those decisions. So just for a little background, my name is Bill Johnson, been in the industry for about 25 years now, 6 of those years on an active trader team with Schwab, published more than 15 books, and I do hold a master's in economics and in finance, both those from UCF. And I'm also a former adjunct professor at FIU, doing futures, options, and swaps. So love to always talk about the markets and hopefully bring you some good information here tonight. So back to the topic here. I ran across this article a while ago, and it was in, of all things, a Wall Street Journal. Actually, I think it's kind of a sub head of the Wall Street called Wealth Management Journal. But it said credit spreads help boost clients' retirement income. And the article was written by a money manager out in California saying we use credit spreads to boost income. We get income coming into the account, and what better way than selling options and selling spreads? And if you read the article, you'd see that there was a sentence in there that said we talk about various ways to raise income without taking on too much risk. So the key phrase there is raise income, and that's what most people focus on when they hear credit spreads. Makes sense, right? It's a credit, you're receiving money. Well, it seems that way, and there's a reason it's called a credit spread, and it's not for the reasons that people think. So the first thing you have to understand is that credit spreads do not raise income at all. They are all effectively debit spreads. So the one thing you never want to do is to select a credit spread over a debit spread just because you think you're getting paid to place the trade. That's what everybody tells me when I ask, why did you decide on the credit spread? And they say, well, my gosh, better to receive money than to spend money. Don't need to know a lot about options to figure that one out. And the truth is, you do need to not know a lot about options to think that it's true. And there are better ways and better things that we look for to decide between the debit spread and the credit spread. So that's what we want to talk about kind of at the end of the presentation tonight. But just to make sure everybody's on the same page, let's take a quick look at a vertical spread. I think a lot of you probably know what these are, and if not, just kind of bear with me, but I want to give kind of a basic definition here. Vertical spread is a type of option strategy where you're going to select an option, and then you're going to sell another one of the same type. That means they both have to be calls or they both have to be puts, not one of each. And of course, they have to have the same expiration date. And if you were to look at those quotes on a quote board, you'd see that they appear vertically from each other, and that's why it's called a vertical spread. So for instance, let's say that you buy the November 50 call and sell the November 55. That is a vertical spread. Buying one call, selling another, same expiration. And in the business, we would call this the 50-55 vertical spread. Now, in this example here, where you're buying the 50 and selling the 55, that would be a debit spread. But we could also take the other side of the trade, and we could be the credit spread. But what people don't realize is that if you take the debit spread, and these are the keys, the debit spread is an asset. It can make you money. And the credit spread is a liability. It cannot make you a single thing other than the credit that you initially received. Now, I'm not going to say that a liability is bad. I'm not going to say that an asset is good. They're just different. But the thing that most people think when you ask them is that they choose the credit spread because they say, I got paid to put this position on, as if they got paid to take an asset. The only reason you get paid is if you are accepting a liability. And therein kind of lies the rub. So let's take a look at some of the details here. Let's start off with buying the 50-55 call spread. We're going to buy the 50 call, we're going to sell the 55. Now, in that case, it's going to result in a debit. And the reason is that there's a pricing principle in options that says lower strike calls have to be worth more money than higher strikes, assuming the same stock and the same time to expiration. So we know without even looking at a quote board that the $50 call has to trade for a higher dollar value. It must. There's what's actually called an arbitrage if that's not true. So we know the $50 call has to cost more. So think about it. If you're buying that really valuable option and you're selling another one that's not quite as expensive, the net result is money flowing out of your account. It's a debit spread. But now let's dig a little deeper and take a look at the rights and obligations. By purchasing the 50, I have the right to pay $50 for the stock. I have the potential obligation to sell for 55. So think about that. If I buy for 50 and I sell for 55, I might earn the difference, or the $5 difference in this example, but whatever the difference is in my strikes. And that is why buying a call spread is an asset. We pay a certain price for it, but it might grow to the difference in strikes. So if we look at this from a profit and loss diagram, we get this kind of a standard vertical spread look. We're going to have limited losses to the downside. That's why the curve flattens out there to the lower left and it flattens out to the upper right. We also have limited gains. So we also get, if you look at the profit and loss diagram, we get bends at those strikes. So you can see that the graph bends at 50 and at 55. And that will always be true in a profit and loss diagram. You're going to get a bend at these strikes. So this is what the 50-55 vertical spread looks like. So if I spend 3, that's the very most I could ever lose. Stock falls below 50, doesn't matter how low at expiration, both options go out worthless and I lose 3. But I might make the difference in strikes. And if I can make 5 and I spend 3, that means the net gain to me is 2. So I might be able to make 2. So another thing to look at here is that whenever you buy a call spread, you are bullish. Just kind of forget about the word spread. You're buying a call. You're buying that more valuable strike, and therefore that's what's controlling the position. That's what makes it bullish. Okay, so kind of hold that thought. And let's now think about the buyer and the seller. Little interesting property for every single trade out there. It doesn't matter what you're talking about. Everything is opposite between the buyer and the seller. If the buyer is bullish, the seller is bearish. If the buyer pays the debit, the seller receives a credit. If the buyer has an asset, the seller has a liability. Everything is opposite. We could even look at the Greeks. One has positive deltas, one has negative deltas. One has positive gamma, the other has negative gamma. Everything is opposite between them. So now let's take a look at the person that sells that spread to the one we just talked about, the person who sells the 50-55 call spread. They would do the opposite. They're going to buy that 55 call, the one that we sold, and they're going to sell the $50 call, the one that we bought. And guess what? Yes, that's going to result in a credit. But look at the rights and obligations. They have the right to buy the stock for 55, and they have the potential obligation to sell for 50. So again, think about it. I have the right to pay 55 and the obligation to sell for 50. What is that? There's no asset in that. There's no gain. That is simply an arrangement where I might owe the $5 difference. So selling a spread is a liability. It's very much like an insurance policy. You pay your auto insurance company a fixed premium. That's the most they can make, but they're on the hook for a lot more. If they weren't, nobody would take the trade. So whenever you sell a spread, you have some type of liability. You've sold something that's not in the account. It's a short position. So the spread seller is going to have the opposite outcomes. They're going to receive the $3 credit. That's the debit that we paid, but they are on the hook for the $5 difference in strikes. And that means, in this example, they might lose 2. So if you sell a call spread, you're bearish. Buying the call spread is bullish. Selling the call spread must therefore be bearish. So now let's compare these two profit and loss diagrams. Take a look at the one in green. That was the long 50-55 vertical. If we spent 3, the person who sells that spread collects the 3. They're just on opposite sides. Where did the $3 credit come from the seller? From the person who bought it. Now, the person in green, if they paid 3 and might be able to make 5, they can net $2 in their pocket. The credit spread received 3, but they might lose 5, and that means they might lose 2. They're just on opposite sides. So now the second thing I want you to notice is that we can get to the bullish or bearish side with calls. And we're going to find out we can do the same thing with puts, and that's going to be important. Okay, I can get to the bullish or bearish side by using calls. Get to the bullish side, I want to buy the call spread, think buying calls. If I want to get to the bearish side, I'm going to sell the call spread. Okay, everybody got that? Let's do the same thing with the put spread. And then we're going to see something interesting when we put it together at the end. I can buy the 50-55 put spread. And to do that, I'm going to buy the 55 put and I'm going to sell the 50. Now, notice I'm buying the higher strike put this time. With the call spread, I bought the lower strike. You see, with puts, it's the opposite. Higher strike puts are worth more money because they give us the right to sell at a higher price. So I know for a fact that's going to sell for a higher price, and therefore it's a debit spread. I've got the right to sell shares for 55. I've got the obligation to buy them for 50. And what does that mean? I might earn the $5 difference. So once again, we come to the same conclusion. Buying a put spread is an asset. Buying a call spread is an asset. We can earn the difference in strikes. If we look at the profit and loss diagram in this example, there's our bends at 50 and 55. If I spend $2 for this spread, but I can earn a maximum of 5, that's the most the spread could ever be worth. Therefore, I might be able to put 3 into my pocket. So if I buy a put spread, I am bearish, right? Think buying puts, buying a put spread, that's a bearish position. Well, therefore, now you know what happens if we sell that put spread. It's got to be bullish. So the person who sells this spread, right, somebody has to sell it. You cannot buy a spread unless there's a seller. Somebody had to sell the spread. And the person that sold it would sell the 55 put, they would buy the 50. And of course, that's going to be a credit. We paid the debit, they're going to get the credit. But now look at what they're exposed to. They have the right to sell for 50, potential obligation to buy for 55. What is that? If I sell for 50 and I pay 55, it's a $5 loss. There's no asset in that equation. I might owe the $5 difference, or whatever the difference is in strikes. In this example, $5. And therefore, selling a put spread is a liability. And again, I'm not saying that's necessarily bad, but people all think it's an asset, and it's not. So let's take a look at this. If I sell the spread and I collect $2, all right, that's all fine and good. But I'm exposed to a $5 liability. There's no asset in the equation. And that means if this thing goes bust, stock goes below 50 at expiration, I'm going to lose $3. The spread is worth -5 to me, but I got paid 2, so I'm going to be in the hole by 3. So now, notice that selling a put spread is bullish. It's the opposite. Buying puts is bearish. Buying a put spread is bearish. Selling a put spread must be bullish. And once again, if we look at the long and short positions, we'll see their mirror images. So focus on the green spread. That's the person that bought the 50-55 spread. If they spend 2 and the spread grows to a value of 5, then the most they can, I'm sorry, let me back up. The person who sold the spread, let's take a look at it there, would receive that $2 credit. Okay, they're just on opposite sides. And if I buy the 50-55 put spread, and I can make the $5 difference, but I paid 2, I could therefore potentially make 3. The spread seller could lose 3. Again, they're just, everything's opposite. So now I want you to think, and let's start putting some things together. Think of something interesting here. What is the difference? If I say, here's a strategy where you can pay 3 and maybe earn 5, it's going to be called a debit strategy. Or here's another one where you can receive 2, but maybe owe 5, and we're going to call that a credit strategy. If you think about it, both can earn 2 and lose 3. They're just 2 different ways of saying the same thing. There's no difference at all. So the thing that you have to understand to succeed with using and making the decisions with vertical spreads is that buying the call spread is exactly the same thing as selling the corresponding put spread. And this is a mathematical fact of an outcome of another strategy called a box spread. And we can show that these two values have to add up to the difference in strikes. So let's go back to our call spread right here on the left. If I buy the 50-55 call spread for 3, and I can make 2, the broker's going to say, all right, the most you can lose is $3, Mr. Trader, and therefore I'm going to hit you for a $3 margin requirement. And this is where a lot of the novices get off and they say, well, gee, that's stupid. I'd rather get a credit. Let me sell the put spread. Because if I sell the corresponding put spread, meaning the same expiration and same strikes, it's going to look exactly the same. Buying the call spread is the same thing as selling the put spread. And mathematically, I know that that same put spread is going to sell for a credit of 2. But people forget that that's a liability. And I could lose the difference in strikes, and that means I might lose 3. So yes, you do get a credit to your account, but the broker is going to say, Mr. Trader, I don't care about how much you can receive. I'm worried about your maximum loss. And your maximum loss is $3, and therefore I'm going to charge you a $3 margin requirement. Now, technically, there's a $5 margin requirement, but because you receive 2, the net is at your dock $3. So take a look at the one on the left and one on the right. One's a debit, one's a credit. They are exactly the same thing. Same profile, both of them result in debits to the account. There is no cash collected anywhere. It's called a credit spread because the option that we're selling is worth more than the one we're buying. But because that's only half the story. The other half of the story is that it's a liability, and therefore where you could possibly lose the difference in strikes. So the net result is it's going to be a debit. So this person that wrote this article has never checked the accounts. He never realized that they were being debited. There was no cash ever. It's a net $3 out of the account. Let's take a look at buying the put spread versus selling the call spread. 2 different ways of doing the same thing. Buying the put spread is exactly the same thing as selling the corresponding call spread. Corresponding, again, meaning same expiration and strikes. So if I buy the put spread and let's say it's trading for $2, I might be able to make the $5 difference and therefore put 3 in my pocket. And the broker's going to say, all right, if you bought that for 2, it's an asset. Worst that can happen, limited liability, goes to 0. And therefore, we're going to hit you for a $2 margin requirement. But what if we like credit spreads and we say, why would you mess with the debit spread when you can receive money? So let's go sell the corresponding credit spread or sell the corresponding call spread. And there I'm going to get $3 in my account. And that's where they stop the analysis. They don't realize it's a $5 liability and therefore you could lose 2. So the broker is going to say, you are exposing yourself to a potential $2 loss and therefore I'm going to charge you an effective $2 margin requirement. Again, technically it's a $5 margin requirement, whatever the difference is in strikes, but because you receive 3, the net is 2. So in both cases, you have a $2 margin requirement. Debit or credit, I don't care, take your pick. They are the same, they are both debits. So, credit spreads do not boost income. They are really debit spreads in disguise. Now, again, that's not saying that they're necessarily bad. We can choose based on, in the real world, even though I said that, buying the call spread, it's the same thing as selling the corresponding put spread. And that is true in the Black-Scholes world, in the theoretical world of options pricing. In the real world, we can get what are called skews and tilts. And because of this, we might find that the debit spread is a little better, or we might find that the credit spread is a little better. And that's the main reason, at least for people, if you're going to start it as a vertical spread and stay in it as a vertical spread, that's really the ultimate decision, is to just look at which one where you've got favorable skews. So for example, let's take a look. This is last week when Amazon had one of its better days. They're down about 4.5%. But here's just a screenshot of some November 9's vertical spreads. I had 11 days to expiration at the time. So take a look at the mark. I think most of you know the mark or the mid is the halfway point between the bid and the ask, and that's most of the time where you're going to get these trades filled. So let's look at the 1565, 1570 vertical spread, which is basically the at the money. Okay, if that stock price was exactly between there at 1567.5, that spread would be trading for about 250. We're a little bit more in the money, so it's trading for a little bit above 250. Trading for 265. What does that tell you about the corresponding put spread? Look directly across the board at this 1565, 1570 put spread. I should be able to sell that for 235. And I can. Those are exactly the same thing. Why? If I buy the one for 265 on the left, that's a debit spread, and therefore the most I can make is 235. But I could also choose to sell the put spread and get that wonderful credit of 235. And the broker's going to say, I don't care, it's a 265 debit. And both spreads are going to cost you 265 and might make 235. But in this case, there's absolutely no difference between the debit and the credit. But that will not always be true. So let's take a look at this one down here. 67.5, 72.5, still a $5 spread. And I pay 280. What's my maximum gain? 220. And therefore, I should theoretically be able to sell that put spread for 220. But look at this. I can sell it for 260. And therefore, I've got a maximum loss of 240. I've got a smaller max loss and a larger max gain. That will always be true. If I got the larger max gain, I must have a smaller max loss. So in this case, because I've got a favorable skew in my working for me here, I would rather sell the put spread than buy the call spread. They're exactly the same in all other respects. Both bullish, both going to have bends at the same spots. Everything's identical, except the fact that I'm getting a little better pricing over here. But again, that doesn't mean that all credit spreads are going to work out that way. Take a look at this one. If I pay 265 here, theoretically, I should be able to sell the put spread for 235 because that's the maximum gain, right? If I pay 265, the most I can make is 235. Got to add up to $5. So therefore, if I look at the corresponding put spread, it should sell for 235 and leave me with a 265 max loss. But when I look at that, I find out it's a little shy, a little under 230. So in this case, even though it's a debit spread, I am better off with it. I would much rather take the debit spread because I have a better risk profile. Don't worry about debits and credits. Worry about your risk profiles. So the decision that you want to look at here is fairly simple, at least for starting point. Choose to buy or sell based on the largest max gain, or conversely, the one with the smallest max loss. And that's the one where the skew is working in your favor. If it's a debit spread, so be it. If it's a credit spread, fine. But there's no reason in the world to say I only trade credit spreads. Or let me write a book on using credit spreads, like there's something magical about it. They're exactly the same thing until we get into the real world and we start looking at skews and tilts. But from a basic idea of buying the call spread and selling the put spread, they're just two different ways of saying the same thing. So from a professional trading standpoint, this is what we teach here, is to look at the trade also based on what's called the ease of the morph. Now, morphing is a completely different tactic that we use a lot in option strategies, so that if the stock, maybe breaks out or breaks down, we want to change direction, or we want to get long, we want to change deltas from positive to negative, whatever. There's a lot of different things that can happen. But let's say that maybe I'm bumping up into resistance. And I think, what if this stock breaks out? And I might end up wanting to be long deltas. If you remember those profiles, I had limited gains. So therefore, I might want to leg out of the spread and just be long a call. Well, I can't do that if I'm short the put spread. I can get positive deltas with a put spread, but I've got to be short the put. And that's going to be limited gains. And it's going to leave me a naked put. But if I want positive deltas and limited gains, I'd rather be long the call. And that means maybe I should lean towards the call spread, even though it's a debit. And even in some cases, if it's not giving me the most favorable pricing, I want to know the one that's going to allow the ease of the morph. But that's at least another consideration that most people never, ever consider. But the main thing I want you to understand is just that you should not base your decision for vertical spreads based on whether it's a debit or a credit. And yet, if you talk to most people, that's what they'll tell you. And the reason I know, ask them sometime. And they'll say, well, why would you want to spend money when you can receive money? And that just shows that they don't understand they're entering into a liability spread. It's not an asset. So the credit is really a little bit of a misnomer there. It's a credit because you're selling the more valuable option, but overall, because it's a liability, it's going to result as a debit. So if you want to profit from options pricing, you must understand how options are priced. And I just can't emphasize that enough. That's where the profits are, is to understand which one gives us the best pricing, how can I control my profit and loss profiles, and how can I use Greeks to my advantage. And those are just some of the things that we teach. So if you're interested, please check out my website, optionsatoz.com. You can also reach me at this email here, bill@optionsatoz.com. Also, for all of you on Facebook, I do have a trading group, absolutely free. Just go to Facebook, type in Options A to Z. It's a trading group. I've got tutorials, videos, all kinds of good information on there. But I hope that at least gives everybody a little glimpse into the other side of the credit spreads. And I think that puts us pretty close to the end here. I want to thank all of you for being here. It's always a wonderful time to present, and I hope you all learned something. So thank you again. Hopefully we'll talk soon.